This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the continued support and for tuning in. If you like what you hear on the Planet MicroCap podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps folks discover the show and join the MicroCap investing community. Registration is now open for the Planet MicroCap Showcase Toronto in partnership with MicroCap Club, happening October 21 through 23, 2025 at the Arcadian Loft in downtown Toronto. Whether you're a seasoned investor or just getting started, you'll want to be there. Please visit planetmicrocapshowcase.com to register, and I'll see you in Toronto. My guest on the show today is Ben Finser. He's the founder and portfolio manager at Kabouter Management. In this episode, Ben shares his journey from a decade at Kabouter Management to launching Capital in 2024 and how his entrepreneurial background shaped his passion for analyzing and owning high-quality businesses. We dive into his exclusive focus on international micro and small caps, a target-rich universe of some 15,000 listed companies in developed markets outside the U.S. Ben explains why these overlooked businesses, often with no sell-side coverage and tiny trading volumes, present compelling opportunities for investors willing to dig deeper. Ben also details his boots-on-the-ground due diligence process, including traveling globally to meet management teams, comparing companies to global peers, and navigating cultural nuances when assessing business quality and long-term growth. We talk about his quote-unquote pseudo-activist engagement approach, where he works alongside management to improve disclosures, expand investor outreach, and unlock value. Finally, Ben shares a case study of a Japanese procurement software company he helped bring onto investors' radar and offers perspective on why U.S. outperformance may be cyclical and why international microcaps deserve a place in more portfolios. And for full disclosure, we mentioned a few names on the podcast today, and I'm not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Ben Finser of Kabouter Management. Ben, thank you for joining me today. How you doing, man?
Doing well. Thanks for having me, Robert.
Absolutely. It's great to have you. So first off, we have to do a quick shout out to Doug Porter for introducing us. So thank you, Doug. Really do appreciate that. Yeah. And Doug's the best. Like, I think
he really is.
Universal approval, like probably the nicest person in one of, if not the nicest person in our industry. Anyways.
Absolutely.
But I'm glad he made the introduction because Ben, obviously we're going to dig into, your passion for investing, your strategy and everything. But what I thought was super interesting, in doing the deep dives through your fund, through your letters and philosophy and everything like that, is you're almost 100% focused pretty much outside North America.
Yes.
So I'm really curious about digging into that, your philosophy, your thesis behind that, as well as, not the worst places in the world to do boots on the ground due diligence. That's for sure. So, before we get into all the nitty gritty, Ben, to start us off, where your passion for investing begin and how did that journey lead you to where you're currently at today with Fin?
Yes, I think my passion for investing really started with an interest in entrepreneurship and business. So when I was quite young, I started a number of small hobby businesses. Like when I was 11 or 12, I really wanted a new mountain bike, and so I lived close to a bike path that was connected to the Golden Gate Bridge, essentially, and hundreds of cyclists would pass by on this bike path every weekend. And so I asked my dad for a loan and got a $150 bike stand and some other equipment to clean chains. And so I started off by just cleaning chains for $5 per bike. And then I started doing other things like changing flat tires, etc. And I was just really interested in the power of business and kind of making money to to buy myself my first mountain bike, and kind of the power of that, going from not having a bike to having a bike after just a few weekends of starting this business. And that transformed into a few other businesses. Like I started a gardening business, and in high school I brought a healthy vending machine to my high school campus, and started that business through a student government group on campus. And when I got to college, I started to think more seriously about investing, because in large part it was just a great way for me to kind of tap into that curiosity about how business works, and what drives higher quality businesses versus lower quality businesses. And so it really started out as just a kind of intellectual pursuit, and just being interested in studying businesses. And so I did a few internships in college, and that actually led me to my first full-time position in Chicago. So I moved from California to Chicago right after graduating college, and I stayed at that firm for over a decade, and then left in 2023 to start my own fund. And it was really that experience that exposed me to the opportunity set outside of the US. So this firm was focused on micro and small cap companies exclusively outside of the US. And
which firm was it?
Kabouter Management. They're based in Chicago.
Oh, which one?
Kabouter Management.
Oh, okay, cool.
Yeah, and it was a really amazing experience for me. I started out as an intern. I got a grant through my college to cover my living expenses for the summer, and so I was able to use that really as a tool to try to convince companies to hire me as an intern. So I'd reach out and say, you don't even have to pay me. I have all of my expenses covered.
Nice.
I promise I won't screw up. And so I started at Kabouter first, kind of a trial period month, and that went into the whole summer. And they asked me back for a second summer, and then gave me a full-time offer after. And I really had an amazing experience there. Really starting out as an intern. I mean, as an intern, they sent me to Europe to go on a research trip to find companies. I ended up finding a small German software reseller that is still in the portfolio today. And so, yeah, it was really an amazing experience. That firm grew quite a lot, and so it was. I was able to experience the growth of the firm, and how the firm can transform. And then ultimately, my goal was always to start my own fund. And so I left in 2023, and with the support of my boss and one of the founders there, started the fund in May 2024. So he was one of my first investors in the fund, and he's been an amazing mentor, and I'm still close to many of my former colleagues. And my focus remains on international micro and small cap, because I really believe that that's one of the most exciting spaces for a fundamental bottoms-up investor globally. There are just very few funds that actually stay focused on this space, because in many ways it's kind of a self-cleansing asset class, because all of the successful small cap fund managers, they usually get a lot of capital after posting really good numbers for a number of years, and then naturally they grow out of the space, and with more capital they're unable to invest in the same microcap companies. So it creates a lot of room for startup fund managers like myself to come in and take advantage of this small cap anomaly that exists. So yeah, I started out as someone who was really interested in entrepreneurship and business, and that's still the case today. I mean, I'm certainly not a trader. I'm a long-term investor. I like to identify really high-quality businesses that I would love to own for a long period of time, and benefit from the pricing mismatch and often the opportunity that exists as a result of larger fund managers being unable to invest in this space.
100%. So I want to dig into your opportunity set that you really is part of your core strategy with the fund. And it's actually quite fascinating that you came from a place where you basically were doing that for 10 years and you're still excited about the same opportunity set. I'm just curious because in US microcaps and in Canadian, North American, like we go through these little cycles, right? Where there's, risk on, risk off, and you really see the microcap space very much affected, by certain, volatility, or especially more so in the last 5 years. No question about it. But it based on, and I'm still a noob when it comes to more international microcaps. I've been diving in a bit more on the pod and talking to more folks about it, but it doesn't seem to have that same kind of, I mean, maybe it does, and I'm just an idiot, but it doesn't feel like it has those same kind of ebb and flows. Especially, geez, you've been doing this 10 plus years, looking specifically at the same opportunity set. While I'm sure there's some fluctuation, volatility amongst that opportunity set, it still gets you going for 10 going on 10 plus years at this point. So what about it is still so exciting and in some cases nascent, to the rest of the, US focused investors who maybe have some exposure, but are still mostly, North American?
Yeah, great question. It's such a target rich universe. So my focus is developed markets outside of the US. So
Okay.
even if you just use that constraint, there's something like 15,000 public listed companies in these markets outside of the US. So it is just such a target rich environment where I seem to never run out of finding really interesting little undiscovered companies that have just been flying under the radar for a few years. And I think in part, that's driven by a few different things. One is in North America, we've seen the number of listed companies decline by more than a half since the late 90s. And outside of the US, we've seen something very different happening. So I think outside of the US and developed markets, the number of listed companies has grown by about a third. But in some specific markets like Japan, the number of listed companies has doubled. And so in Japan alone, there are as many public companies as there are in the US. So I think there are just so many companies to sift through. And obviously, a lot of these companies are not investable. I have really strict criteria, but it creates a really interesting environment where I'm not choosing between 100 high quality microcaps in the US. I'm choosing between over 1,000 depending on how I'm screening outside of the US. So yeah, it's there. I think a number of other kind of structural drivers that create this inefficiency. So I think one is, in the US, we have Wall Street, and the US is really a financial capital. And, one way to look at it is in the US, the number of sell-side analysts per company is just far greater than outside of the US. I often find, and I have many companies in the portfolio that have zero sell-side analysts covering them. And so, there just isn't really a culture of capital markets. And, you can look at various metrics, including, the local population exposure to local equity markets. And in Europe, in Germany, a lot of people have their wealth in cash, bonds, real estate. And exposure to the equity markets is not what it is here in the US. And so in many ways, it was a blessing to grow up here in the US in a much more sophisticated capital market culture, and then almost export that analytical knowledge and practice outside of the US, because inefficiency doesn't mean that every company is cheap. Inefficiency can mean that a little company is way too overvalued, in part because there's not enough sell side coverage to really tame the enthusiasm that could exist in the retail space, et cetera. But that inefficiency really creates an opportunity for an investor like me to come in and make that determination, whether a company is cheap, and look at the company through the lens of a professional investor.
Absolutely. I mean, it's a very interesting opportunity set, because I mean, do you think also, I mean, obviously you stay more in the developed countries right now, but I mean, from the 12, how many, what was it, 15,000, from the 15,000 plus that you screened for, then narrowing it down, what's some of your criteria for then narrowing it all down to maybe the few thousand or a couple hundred that you're like, all right, let's do the deep dive and then plan an amazing trip to go and see the company, operations.
Yes, I try not to exclude companies or too many companies during my initial screens, because often, and over the last 12 plus years, I've just found that there can be companies that screen quite poorly, but there's actually something really interesting and they turn out to be a really great investment. There can also be companies that screen incredibly well, and I show up and the company is not what I expected. And so I use criteria like market cap. So generally I'm looking for companies that are too small for many of the global funds to look at. So, a lot of these global funds will have certain criteria, like they won't look at companies that trade less than $1 million in, average daily traded value, or companies that are, under a billion or under a couple billion in market cap. And so I try to focus my efforts on smaller companies because those are the ones that these larger professional funds are just unable to analyze. And then I'll look at things like how the company has performed historically. So I think a misunderstanding is often that these microcap companies are startup businesses, but that's really not the case. Many of these companies have operated for decades, and many of these companies have been listed for over a decade. So there's a lot of history to look back at reported financials to understand, do they have a proven business model? How has the company performed during past economic downturns? I run a really concentrated fund, and so I'm looking for some of the highest quality businesses that I can find. And so some of the things that I'm looking for are how the company has performed over time. There are also kind of some red lines, like generally I won't invest in companies that have a levered balance sheet. So it depends on the industry, but generally I look for companies, that have less than 2 times net debt to EBITDA. So there are certain screens that I can create there. And in large part, I'm looking for companies that can finance their own growth, and they're not reliant on, bank financing in order to grow. Because often when things get tough and we face an economic downturn, many of the smaller companies are unable to continue to get this financing. And so I'm looking for companies that really can sustain that growth using their own resources, companies that are cash flow positive, companies that can use those cash flows to fund future growth. And so, yeah, there are a number of different screening criteria, but in general, I try to leave a lot of leeway to take a chance on companies and meet with them anyways, just to understand, is there something there that could be interesting?
So what's your thoughts, since you do focus internationally? Like I've talked to a number of investors that, maybe they live in that certain country and it has its own, capital markets infrastructure, stock exchange, publicly traded companies, but they've straight up said like, I do not touch them with a 10-foot pole. Not that they might be, bad companies or anything like that, but, they just, their main market is within country and it's a smaller population. So they don't see, the real growth in those companies. From your perspective, when you're looking at these companies, do you tend to focus more on the ones that have a more global customer base, or do you make exceptions or look also at companies that maybe are just specifically selling in country?
Yeah, I look at both.
It's interesting, by the way, I'm going to preface that by saying
Yeah.
it's a uniquely American question, because for us, like, you say you're selling in the US, like, okay, yeah.
Yeah.
Even if you're just in the US, that's fine. That's 300 million people, like, richest country in the world. But it's different when you're starting to look at some of these other countries that have smaller population sets, that kind of thing. So go. I apologize.
Yeah, I have some companies where the US is their largest revenue source, and then other companies that are totally focused on their domestic market. So it really depends. But I do often find that sometimes the companies, that are what some investors call analytical orphans. So, they might be a software company in a local market that primarily has, oil and gas businesses or mining companies or financials. Like, Italy historically has had a lot of insurance companies, banks. If you're some specialty industry and you are growing quite quickly, sometimes the multiples can appear to, trade at a premium to the local market. And as a result, the local investors think, oh, that stock is too expensive because it's trading at a premium to the local market, not realizing that, the local market has a really low multiple, in part because it has lower quality businesses or businesses with more cyclical exposure, and so there can often be a lot of advantage that I can derive by being a global investor and comparing these local companies to global peers to try to understand what their fair value might be. And so I love finding companies that really are global players in some niche industry, and they're just not properly understood by the local investors. I've even had companies that many years ago, I had it's not in the portfolio today, but I had a company that was listed in New Zealand, but 98% of its business was in the US, and local investors just didn't understand this business, and they weren't really able to wrap their head around the value to assign to this business. So I think being a global investor is really a big advantage in assessing what a company is worth and kind of coming up with a target multiple for, eventually when these companies get discovered, what would larger investors pay for a company with these characteristics?
Absolutely. All right, so let's get into one of the main things I wanted to chat with you about. I actually wasn't planning on it. I figured we'd touch on it a little bit, but you truly have in really diving deep through your letters and everything, you have very much a heavy focus on boots on the ground research. From your perspective, once you're taking an active interest, I'm not sure if you take a little, your process of, your buying process, maybe you take a little bit, you buy a little bit and then go and do some, you can tell me, but what then entices you to then say, okay, it's time to go and check out this company, meet management, see what's going on. And then from there, once you made the decision, you get there, what are some of the criteria, things that you're also looking for in order to both support the thesis and or break the thesis?
Yes. Yeah, great question. So I start with screens, and so I'm doing screens at least quarterly, globally in all of my markets, trying to find potentially interesting companies. And so often what I'll do is I'll do an initial screen. I'll add some filters to it, as like I mentioned before, and then individually I'll just go through these companies to try to understand whether they could be interesting for the portfolio. And if I think that they could, I'll add them to a list of these companies. And then my travel will be determined by the number of interesting companies in each of the countries that I'm visiting. And then, if I'm planning a trip to Japan or to Italy, then I'll do another screen to make sure that I haven't missed any other potentially interesting companies. And really what I'm looking for, I think, can be boiled down to just a few things. So one, I'm looking for companies that have a proven business model that have a high quality business model. So I measure that in a number of different ways, like the percentage of the revenues that are recurring, or the churn that a company has, or the historical performance of the business, how the company's performed during past economic downturns or periods of heightened challenges. So quality of the business model is one. Another one is trying to understand whether this company benefits from more structural growth or cyclical growth. So I'm looking for companies that benefit from a long-lived growth theme. So it could be taking advantage of a demographic shift or a business culture change, like an efficiency driver, for example. And I'm trying to craft a story around why this company grew for the last few decades and why that growth will continue into the future. And so I'm really looking for structural growth. And then lastly, I'm looking for companies that are trading at a discount to their fair value. So it could be, a company is a niche vertical software company, and they have high recurring revenues, and they're trading at half the multiple of a global peer set, then that would be really attractive. So when I meet with companies, I'm really trying to fill out that investment thesis during the meeting in real time. So I always try to meet with the key strategic decision maker. So a lot of investors, I think, when they meet with companies, they like to meet with the CFO to ask financial questions. A lot of my questions during the initial meeting are much more focused on the long-term strategy. So usually when I meet with a management team, I try to understand the history. Up until today, what were the key milestones, and to try to put together the story of how the company was formed, what is their reason for being. Next, I try to understand the business today and their business model. So, why do customers choose them over competitors, or how were they able to continue to grow during the financial crisis while many companies in their local market saw revenues and profits decline. And then the third kind of area of discussion is, where do they see the business going in the future? So what are some of the key opportunities that they're looking to exploit, and what does the future look like through their eyes? And usually I come into the meeting with my own idea of what the investment thesis will be. And so I'll often, throughout the meeting, just try to adjust that thesis and to really relay back to management what I'm thinking, and to get their feedback as well, to understand, maybe your total addressable market is larger than other investors think, because not only can you expand your market share, but you can expand your wallet share within existing customers. Let's try to quantify that potential. So I'm really in real time trying to update and to adjust that investment thesis. And so many companies will turn out to be far more interesting than I thought, but also a lot of these meetings turn out to be a total disaster, and it's nothing like I expected. And so I would say in a typical week, if I meet with 20 companies, maybe 2 or 3 of them are added to my deep dive due diligence list after that, and the rest, I'm monitoring for something, or I just determine that they're not interesting, and I won't focus on them anymore.
Or wait for new management, it sounds like, in some respects.
Yeah.
I mean, in some of those meetings, and I'm sure for quite a few of these, English is the second language, and I'm curious as to some of the difficulties that you've experienced in some of these meetings where you're just, you're trying to, give your insights, give what you're thinking, and it's met with maybe a cultural backlash that, maybe you knew going in, but you're like, I kind of have to, put it forward. Like, have you ever had that experience with management teams where, it's just, there was just a clear cultural difference and that was why there was a misunderstanding? You don't have to name the name of the company or anything like that, but I'm sure that's happened multiple times.
Yeah, absolutely. I mean, each country is a little bit different, and I think that's where my experience from that first research trip I took when I was an intern in 2011, I think just over time I've learned a lot about each of these markets. In Japan, my first trip there to meet with companies was 2013, and I distinctly remember that a lot of the management team would say yes, and I didn't recognize until after the trip that yes in Japanese doesn't mean yes, I agree with you. It means yes, I acknowledge what you just said, but it's very different. And so, using an interpreter, they will translate, yes, and I always need to follow up. And if their answer is just yes, I need to follow up to make sure that they're not just acknowledging my statement or my question, but are they agreeing with me or not? So there are many examples like that. I think having a cultural understanding of the nuances between different markets is really helpful. In addition to being an American citizen, I'm also a German citizen, and my family is European, and I spent a lot of my childhood in Europe, and so I think that. Where that's particularly helpful is not actually as much with the language, but it's much more kind of with the general approach of, understanding communication differences. There's a great book called The Culture Map. I think that does a great job kind of describing that, each country has a different culture, and, some countries, the management teams can be very optimistic and bullish, and you kind of need to take their statements with a grain of salt. In other markets, they can be really understated. And so I think understanding each of these cultures and the differences is really important. And so I think having that cultural background was quite helpful, because I'm not showing up as an American assuming that each of these markets will communicate in the same way that other Americans communicate. And I think I'm more easily able to adapt my communication approach to the local market, and I'm more sensitive to some of those differences. And so I think that's helpful during these initial meetings, but it's probably even more helpful when I'm engaging with these companies to try to help them as a partner later on once I'm a shareholder.
We will definitely get to that, and I'm really interested in that too. But real quick, I mean, I'm sure you also came across this I'm sure some of these companies also had an impression, like, all right, who's this American fund manager? Like, what American, just a cowboy coming in, or like, I'm sure that's also something that you've had to at least have an awareness of, that hey, some of these companies might have a bias, not necessarily bad or good or bad, just they have a bias of American businessmen coming in to talk with them for whatever reason. So have you come across those? And then also part two of this question is, how difficult has it been also to get some of these meetings? Sometimes it's hard to find who the right contact is, or they think it might be BS, or some American random portfolio manager coming to want to see us and see the facility. So love to hear your thoughts on both.
Yeah, I think it often plays to my advantage that I'm, based in the US and run a US based fund that is looking overseas, for a number of reasons. I think one, many European or Asian business leaders actually admire a lot of the public listed companies here in the US. And I think in their eyes, they view it as a really positive signal that an American fund manager is even interested in their companies. Many of these companies listed over a decade ago, and the local investment bankers promised them a lot. They said, once you go public, you'll have access to the capital markets, your cost of funding will come down dramatically, you'll get all of this interest, investors will love you, and in many cases, their share price went nowhere, or they didn't get the interest that they were promised. And so, or
Wow. There's no cultural differences amongst investment banks, in the US
yeah,
or otherwise. That's hilarious.
totally. Yeah, and I think many of them, they might get attention from local investors, but I've even heard feedback that a lot of these local investors are sometimes overly focused on the short term, or they might be focused more on the noise because they are there in the local market, versus a lot of questions that they receive from foreign investors are much more focused on the long-term thematic opportunity, for example. And so I actually get a lot of positive responses, and I think it's easier for me to schedule meetings. When I'm planning a trip, for example, let's say to Tokyo, I am there for a few weeks, and I have those set dates. And I find I'm able to get a lot of the meetings that I request. But what I hear from local investors is because they're already there in Tokyo, the management team feels, that they don't have to adjust their schedule in order to meet with those investors. So I often find that, they're very accommodating, in part because I traveled so far to meet with them. And for local investors, I think sometimes it can actually be more challenging to get meetings, or they might have to wait until the analyst meeting that's taking place in a month or something, versus me. So yeah, I think my experience meeting with these companies has been quite helpful. So I've met more than 100 companies a year, doing at least 3 or 4 international trips a year for the last 12 years. And so in many of these markets, I'm already very familiar with these companies, or, I met an investor relations officer who worked at one company, and now, he or she has moved on to another company. And so it is quite a small universe. Or even amongst the sell side brokers, they'll move around to different shops, and they can also facilitate some of these introductions. I would say another way that I find it really helpful to meet with companies or even get introductions is through other investors. So I've built up a network of other local investors that focus in the microcap space. So it might be a local family office, or a small fund, a small mutual fund, etc., that is invested in this company, and they can facilitate an introduction. So yeah, I actually find that being a foreigner, I think, is, especially coming from the US, is actually has been a really big advantage.
All right, that's awesome. All right, so now I want to get into well, I definitely want to get into story time. I'm sure you have some great anecdotes of ones, but I think even before that, like, I want to finish off the process and criteria or philosophy, strategy, all that, because I think the final leg of your stool is your emphasis on engagement. You brought it up before. I said we're definitely going to get to that. Here we
Yeah.
are, talking about basically your kind of pseudo-activism, suggestivism. So can you tell me a little bit more about how you engage these companies where it might be a little bit of a different conversation, or is it not a different conversation? How much are these recommendations or suggestions, how are they met, versus maybe some of the more the US based CEOs that are probably very used to, like, okay, yeah, like they know how to respond to that. Maybe some of these CEOs aren't as, used to having these types of conversations. So I'd love to hear the whole philosophy and thought process there.
Yes. Yeah, I'll, by the time I invest, many of these management teams have really gotten to know me, because I've visited their factories. I've met with them a number of times with other members of the management team. And often after I build a position, I'll talk to the CEO, and I'll say, I have good news and bad news. Good news, I love your company. I think you've built an incredible moat. You I love the fact, that you can continue to grow at, this low double-digit rate. I think, you could even accelerate that growth in the future. There's margin expansion potential, et cetera. So, I'm giving them my investment thesis, and I say, but the bad news is no one else seems to recognize all of these amazing qualities about your business. And so let me help you to accelerate your re-rating to fair value. And in many ways, the management team is quite receptive to that, because many of these CEOs, they have a lot of skin in the game. They might own 20% of the company themselves, and they've been disappointed since their IPO that foreign investors have not discovered their companies, or they have been ignored by local investors. And so I think in many cases I'm one of the first investors to come to them and really to validate their thesis and to say, I'm totally on board and I agree, that you have this amazing business. And so let me help you get discovered. I'm not showing up like a traditional activist and slamming my fist on the table and saying, sell all of your real estate and lease it back, or get rid of a particular division. The premise of my recommendations is really, you have this amazing business. Other investors should see that quality as well, and they, I think, will pay a much higher multiple than your current multiple for this kind of earnings growth and this quality. And so the CEO is often really on board. I've only had one or two cases over my whole career where a company was not receptive to recommendations. But once I get that initial buy-in, then I start with really low-hanging fruit. So I'll say something like, you've built this amazing data business and your customers are global. You might have started out in France, but France is less than 10% of your business today. Your Germany is your largest market, et cetera. But still, your earnings calls are only held in French. Your presentation materials are only in French. So it just becomes really difficult for German investors or Italian investors or American investors to discover your company when all of the materials are in a different language, and it's really challenging to join an earnings call when you don't speak that language. And so really simple things like encouraging these companies to start holding quarterly results calls in English, or to start publishing their presentation materials in English, or to the extent that a company has not visited investors outside of their local market, to help a company plan an international roadshow. So a lot of my advice is focused on investor relations and trying to get a company discovered by more investors. And so it's very friendly advice. And I think sometimes a management team can be skeptical, but what I've found is over time, I am really able to prove myself as a valuable partner to these companies. And I've used references before, like companies in that same market that I've been working with for 10 plus years, and they might know each other. And so I might say, yeah, one of your peers, that podcast that they went on in the US that helped them get discovered by Artisan or whatever, I made that introduction, or I could. So I think having that experience can be really valuable in convincing companies to take my recommendation. But it's also free advice. So I'm coming to them saying, I'm in the same boat. Our interests are completely aligned. I'm a shareholder, and if you follow these recommendations and if you improve your presentation materials in the ways that I'm suggesting, we'll both win as a result. Because many of these companies, they've traded on a low multiple for a long time, and if they are able to achieve a market multiple for their company, their cost of capital will come down, and they're able to do more of their strategy at a lower cost. Maybe they can acquire a competitor using their shares. Maybe they can expand to a new facility, et cetera. So having a stock price that is aligned with the value of the business, I think is really critical. And many of these management teams do understand that. I think many of them are just a little lost, or they don't know exactly what investors are looking for. They're amazing at selling their product or service. And I always tell them, in many cases, these introductory meetings are just, the presentations that they're using are just a repurposed sales presentation. And so sometimes they'll get into the weeds on topics that customers care a lot about, but they won't touch on topics that investors care a lot about. So, investors would love to see that the customer relationship is quite sticky and that it's very difficult to switch to another supplier. That's not something you would have in your sales presentation or something you would advertise to a potential customer, but investors would love to hear that. And so I often really help these companies understand what investors are looking for and how to adapt their presentation to address those concerns or questions that investors have. And many of these companies don't realize that investors have a very short attention span, I think, and many investors have just a large universe of companies to look through. So if you're not spoon-feeding investors like analysts and portfolio managers the information that they need, if you make it too difficult for them to find that information, they'll just move on to another company. And so that's happening in many cases with these businesses. And I think over time they recognize that value. And many of these companies will start asking me questions outside of investor relations. Like, they'll ask me, sometimes they'll say, can we wall cross you? Like, can you become an insider for the next 2 weeks? Where you can advise us on whether to use our shares or debt for a new acquisition that we're planning to make, or how do you think the market will perceive this action, or we're thinking about implementing a new long-term incentive plan for our executives. What do you think about, X, Y, and Z? And so the advice that I provide can become much more strategic over time, especially when I prove myself with investor relations.
I'll tell you right now, I think you're saving these companies a lot of money on IR and advisory services, that's for sure. But yeah, no, look, you're aligned, right? Like, you're a large shareholder in many cases here, and you just want to make sure that the company is properly presenting themselves in a universal language that speaks to every quality fund manager. So,
yeah.
I'd love to hear an example. We've been talking through strategy. I think now we're at that point where, I'd love to hear of an example where, full process. You found it from the screen, did some of your due diligence, hit some of the metrics, you went on a site visit, were thoroughly impressed, but maybe there's some things that, you could help out with on the IR side. And then, ultimately, they recognize some more value as a result of everything. Just give us a full example. Love to hear one.
Okay, great. Yeah, I think since the fund is still small and still adding to positions, maybe I won't mention it by name, but I can kind of walk through what the company does and the process. So there's a company in Japan that provides procurement software for large Japanese customers. So these are, the Toyotas of the world that have lots of subsidiaries themselves. And so what this company does is they help the procurement teams within these organizations purchase products at better prices. So they have cost comparisons between, Amazon and the local provider Monetaro, or many others. It could be directly to the supplier. So to help these companies choose the best price, but then also feed into their ERP system to purchase and account for all of these expenses. And so in many ways, this helps reduce costs. This helps to reduce the number of employees that their customers need. And the implementation can take, a year to 3 years. And so once these customers decide to use this company, they don't replace them, so they become fully embedded within their customers, and their churn is close to zero. They haven't lost a customer in the last 5 years. And once they embed themselves within one of these large customers, they're able to continue to grow by proving themselves in one subsidiary and then expanding to other subsidiaries. And so this company was trading at a market cap less than $100 million. And so, foreign investors had not met with this company. Even a lot of local investors were not paying attention to it. And when I met with them for the first time in 2024, they were really proud to show me that they had created an English presentation just for our meeting. And so we spoke about the business, we spoke about the growth opportunities, and I really tried to understand, why is this company trading on such a low multiple for having, such sticky customer relationships, to have such growth potential. And I found that it was for a number of reasons. I mean, one, the company didn't have investor relations materials that described the growth opportunity. They didn't have materials that described the business model. And one of the challenges that they had is they had kind of this gross revenue, net revenue issue where a lot of these products that were purchased went through revenues, even though their margin on those products is relatively low, but they were really providing a software. And so the net revenue was a much better figure to use. And so, when local investors would screen this company, it looked like their margins were like 2%. But in reality, they were much higher because local investors were just using the wrong revenue figure. So, there can be a lot of issues, and I think the management was really frustrated that they had not received the kind of recognition that they deserved. And so I helped them on a number of things, including making recommendations to improve their presentation materials to describe their business model so that investors could understand the value that they provide. Including, making certain disclosures around how sticky their customers were, how they hadn't lost a customer in 5 years, what the growth potential was, translating these materials into English. And just recently, they took a recommendation to come up with a midterm plan. So, it can be one thing to say, we have this huge TAM, we have a potential for margin expansion, but I think for a management team to come out and say, this is our target in 3 years, carries a different weight. And so they did that as well. And so as a result, a lot of international investors started to discover this company. Local investors started to discover this company. And so that's kind of a similar progression to many of the companies that I'm looking at where, I find a business that could be potentially interesting. I meet with them and really discover that local investors are not recognizing the quality and the growth that exists in this business. And if the management team just did a better job disclosing their growth potential or their business model, then investors would at some point discover the company. It's why I have such a long holding period, because that discovery process can take a year or it can take 5 or 6 years. And so my goal is really to find high quality businesses that I would be comfortable owning for a decade, even if they weren't discovered. And in the meantime, they're growing businesses, so I would continue to get their earnings growth and the dividend growth, and that multiple re-rating that could occur in year 5, it could occur in year 7. I'm quite confident that at some point that will occur, because there are these are great businesses, and I think at some point foreign investors will discover that about these companies, but it can just be really difficult to predict when that will actually occur.
I got a weird random question. Now that I've been doing a lot more interviews with either US focused, now looking abroad, or more international investors that are kind of sticking to their knitting, When do you think, because one thing I don't hear about as much, I mean, we hear about it with Canada where you might have some US competitors going pretty active in M&A. It slowed down a little bit, but it has its fits and starts and it's always volatile. But you really don't hear a lot about, US or Canadian or North American, either strategics or PE firms or what have you, looking at some of the inefficient microcap international markets for potential acquisition opportunities for M&A. Why do you think that's the case? And do you think that'll ultimately change in the near term?
Yeah, there has been some aversion in some markets to PE activity. Like in Germany, for a long period of time, a lot of these kind of middle market companies, often referred to as the German Mittelstand, these companies were hesitant to sell to private equity because there had been a number of cases where private equity had taken over a business and then fired a large percentage of the population, and often the
I see.
founders continued to live in the local market, and they care a lot about the continuation of their baby, the business that they formed, and so they're looking for a responsible buyer. I think that is starting to change, and we are seeing some more PE activity. Or in markets like Japan, a lot of the big funds, PE funds in the U.S. have launched Japan-focused funds in the last couple of years, and so they are looking at the market, and I think there's just a ton of consolidation potential. There are so many fragmented industries in Japan, that have not been consolidated like they have in the US. And so I think the potential both for these foreign funds, but also there's been growth in domestic private equity funds as well.
Right. Listen, I asked because, in the main headlines, you always see that it's the foreign companies coming in and buying up U.S. companies to get, U.S. exposure. But you haven't heard so much in the mainstream press about, U.S. international companies or U.S. companies looking at some of these international, whether it's middle market or large cap, unless it's the forced sale of TikTok, which that's a whole other story.
Yes.
So, look, we've covered so much here today, and there's a lot more, but I wanted to kind of close out on kind of a two-parter. One is your forward outlook. I mean, you're clearly, you're covering all these areas. I don't know how much you're covering on the macro side. I'm not really asking that, but I guess more of like what's kind of the economic situations or what areas are kind of becoming more interesting to you just based on your own bottoms up research. And then part two, for those that maybe are kind of wanting to start to dip their toe in international microcaps, what are some of, best practices or things that you would recommend for them to do?
Yeah, I think that maybe there are a number of ways that I can answer this. I think one is being a U.S. investor, there's a lot of home bias. And if you look at the typical portfolio, for a lot of institutions like, endowments and foundations, a lot of their portfolio is concentrated on the U.S. And so I think that there's potential for more of that capital to show up elsewhere in the world, because there are amazing companies that are listed all over the world. And I think these local markets could really benefit from more interest and more capital flowing there. So, we saw that a bit with fund flows during the first half of this year. And I think a lot of institutional investors in the US are looking overseas at opportunities that exist. I think many investors forget that these capital flows are cyclical, and U.S. outperformance that we've experienced since the financial crisis, is a cyclical phenomena, and I think that won't continue forever. There are fluctuations in the relative attractiveness of different markets. Even currencies follow cyclical fluctuations, and so I think we're very long into this U.S. outperformance theme, and I think if you look historically, the average period of U.S. outperformance has been, 7 to 9 years, and we've far exceeded that. And so I think it becomes incredibly difficult to predict when that will change. But I think a lot of investors, have done quite well if their portfolios have been focused on the U.S. for the last decade plus. But going forward, I think the U.S. trades at a much higher multiples than what you see in other developed markets outside of the U.S. And some of that is for really good reason, but a lot of that is maybe just more of a cyclical dynamic. But for me, I'm really looking bottoms up for great businesses that are undiscovered. And so I've experienced different cycles throughout my career, and I've never really ran out of interesting companies to find, in large part because it is such a target-rich space, and there are just so many companies to choose from. And I think there are many different ways to play these markets. For me, I'm really looking for high-quality businesses that can do well over a long period of time and have really proven themselves in the past. And so I think many of these companies that I'm identifying have already proven that they can do well during economic challenges. So, if a new tariff is announced, or if the local market is facing additional economic pressure, many of these companies have proven themselves as providing a necessary product or service that continues to grow or continues to retain its customers during an economic downturn. So I'm very focused on quality and trying to find companies that can withstand challenging periods, because I'm certainly not a macro investor, and I'm not in the business of predicting interest rate movements or economic growth. And I'm really looking for companies, that have maybe operated in a market where economic growth has been flat for a decade, or the market in Japan just has been quite flat for a long period of time. It hasn't been until recently that there's been more interest in Japanese companies. But a lot of investors have done very well in Japan by just picking some of these winners, some of these companies that are under the radar, will continue to grow their earnings and can benefit from an additional kicker of a multiple re-rating when other investors discover them. So I think there are a lot of interesting macro developments or thematic developments. Like, I think AI will be very disruptive. I think, the aging population creates both challenges and opportunities. And across Europe and Japan, I think being an investor in these foreign markets is a really fascinating job, because I think there are so many influences that can affect a company's growth opportunities, a company's business model. And so I find it really fascinating to be an investor in this space, because every day I can wake up and read The Economist, or read a blog, and often what I'm reading relates to one of my companies or a company that I'm looking at, and it becomes it's a fascinating job to try to have this curiosity and to try to understand the world, and then have a way to put that knowledge into action through buying and selling these companies.
Hey, that all comes through clearly on today's pod and conversation. That's for dang sure. So, Ben, with that, where can our audience go and find more information about you and Fin Capital Management?
So I'm on LinkedIn. So yeah, maybe that's the best place to find me. I love to connect with like-minded investors, both because when I'm engaging with a company, I like to make introductions between that company and prospective investors, but I also feel that having a network of like-minded investors is helpful to run ideas past, to learn from other investors. So yeah, please feel free to reach out to me on LinkedIn, and it would be great to connect.
Awesome. Well, Ben, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next conversation.
Likewise. Thank you, Robert.
Thank you.